Hey, what's going on, you guys? Welcome back to another YouTube video, and on today's video we're going to go over a little bit of risk management. I hope you guys don't mind the background changing a little bit. I am currently right now preparing to finally make a really big change in my life. For the last, you can say 15 years of my life, I've grown up here in the Inland Empire, living in a beautiful city here in California known as Fontana. I went to Rancho Cucamonga for about 2 years, and now I'm going to be moving to LA County. So it's a little bit near the coast of California, not a lot closer to the beaches. I'm gonna be a little bit away from my family, so me and my fiance are gonna be moving out there, and right now she's recovering from her surgery, so she's just about to go back to work. We're gonna go ahead and let her get some months in at work, get in a bit of a better financial situation before we go ahead and pull the trigger and finally move out there. But in the meantime, I am kind of moving a lot of my belongings into my parents' house to kind of build up a little bit of a kind of storage here in the meantime that we kind of settle out in LA County. So I hope you guys don't mind the change, but today's gonna be a really important video. We're gonna be going over risk management. So this is something that I can always stress to you guys is going to be the make it or break it in your trading career. It doesn't matter if you set the right key levels at supply, demand, support, resistance. It doesn't matter if you're well informed on macro data, if you time CPI right, if you time the FOMC right, if you are watching the right headlines. There's so many variables that if you don't incorporate the right risk management of what your portfolio's value is at or how much you enter on a position, dude, you will never see progress. Or if you do see the progress, you can wipe it away in just 1 or 2 trades. So in today's video, I want to go ahead and jump into that with you guys, because I know a lot of individuals, especially like those trying to get into the trading space, like they're practicing with paper trading, and sometimes they do really good. When they're paper trading, the emotions behind real money isn't there, and then when they go onto live accounts playing with real money, now they're kind of getting impacted. They're not performing as well. Their emotions are different, and this is a big component. Like, it's not easy to overcome. Thankfully, like, I have around 5 to 4 years of trading experience, and I've gone through a lot of mistakes. Like, I remember one trading day, I lost over $60,000 in one day. Like, that's another video where I'm gonna talk to you guys about emotional regulation and impulsiveness. That's a real big component to this as well. But I understand truly the consequences of not implementing the right risk management, about getting on a high horse, making $100,000 in a day, and thinking that the next day I'm gonna go all in, make 200,000, and I get wiped for 60 grand in a day. That was real. That is in my phone. That is one of my probably most traumatizing trades of my whole entire career. And I share this with you guys because, I don't want any of you guys to go through that. I want you guys to have a good experience with trading. Despite it, as much as I want that for you guys, it's probably not going to be that way. It's a really difficult career path, a really difficult stream of income to really sit down and be bad at, lose money at, and still maintain a positive mindset on your future, making it something that eventually you guys can live off of and provide for not only yourself but your family financially. And I add that as an advisory because I don't want you guys to think just because you see everyone on the internet making a shitload of money that this thing is rainbows and sunshine. There is that trade right on my phone right here on SoCal Trading Group. Jerry trades his phone, right? Opening up my Robinhood app, boom, right there. Minus $62,000 in one day. And that's because I was a young 21, 22-year-old not implementing risk. I was just sending it. Of course, it's a pretty immature term to use, but I was filled with greed. I wanted the money. I wanted it fast. I wanted it heavy. I wanted it nasty. And I got blown for someone's yearly salary in one day. And yeah, talk to me about the mental fortitude that it takes to continue showing up here about a year later. I'm telling you guys, it's not a one shot to success. And I mean that with all my heart. So I want to help as many of you guys as possible avoid that, And of course, just to kind of add credibility terms for those that are like, well, why would I want to learn from someone that lost that much money? Well, the next day, I got to do this stuff because, the world's weird. A lot of people, they judge you. They, don't really take too much credibility from someone that goes and loses money like this. But for a credibility purpose, that happened on 4/11, right? later on in that day, I went ahead and made $65,000. So I made it all back, you know. Thankfully, let's go ahead and get that zoom. I made it all back. You can see the back-to-back trades right there. There's the minus 62 and then there's the plus 65. So I know what it's like to lose that much money, but I also know what it's like to make that much money. So I know exactly what I'm telling you guys. Now that we established credibility, we established a little bit of reference, you guys know how serious this is and why I'm advising you. Let's go ahead and jump into the good part. Let's go into the information, right? So if you're scaling right here at an account, you know, and I know most individuals, like, one thing I have to tell you guys about is don't be fearful, you know? Like, find contracts that are 0-day expiration that allow you to kind of play with your capital. Of course, I'm not trying to steer you down 0-day expirations. They're extremely high risk. You can pay significant consequences, but I highly advise you guys take the approach into trading that isn't going to hurt you too much financially. And typically that means 0-day expiration contracts, because 0-day expiration contracts, the max probably you're going to pay for at the money or potentially even in the money could be around $100. Of course, we're not going to say that that's not a lot of money to some individuals, but hey, if you're looking to step into trading, that's a lot of that's the most you can potentially pay. Of course, you could go really in the money, pay multiple hundreds, but to have a good entry that doesn't have too much risk to it, you could get it at the money for $100. Now, I myself trade out the money. So when you trade out the money, these contracts are significantly cheaper. Now you're probably going to pay $30, $20. And this is important here because, you know, you are now going into two different factors of risk management. You're either going in with the safe strike price to manage risk, or you're going with the out the money strike price, which is not that safe, but you're protecting capital. So depending on what kind of portfolio you have, and this isn't really too, I guess you can say, broad for everyone because people have different financial situations, but hypothetically, if I have a portfolio that's valued at $100 or $150, just for beginners starting those small accounts, I know I primarily want to help the youth, and we work really hard for our money when we're young. You know, the jobs that we have don't oftentimes pay us. We're oftentimes making sometimes $200 to $300 a day. So yeah, that cost on these contracts does get significantly, we feel that, you know, it's a couple hours of our work. So with that being established, you know, if I have a portfolio value of 150, hey, do I want to take the out the money that's going to cost me $30 and play a higher risk position in terms of strike price? Or do I want to play it in the money at $100? Do I want to play it a lot higher risk to the total value of the portfolio, but now a safer strike price? And I'm going to tell you guys the advice that probably no one ever told me. That's going to be a little bit contrary to the majority of the risk management advice that I'm going to tell you guys on the channel. But when you're scaling with such small capital, dude, you got to go with the out the money. And I'm going to tell you why. When you go with the out the money contract, it's probably going to be $30, $35, all right? You are in charge of that position. You can decide to cut that position at a minus 20%. That's minus $7, by the way. $35, 10% of that's going to be $3.50. Times that by 2, you have $7. Hey, you just lost $7. You lost a bag of chips and a Gatorade at a gas station in California, if that. Probably even more nowadays with this economy, but it's not going to significantly impact you compared to a 20% drawdown on an in the money contract, and now you're down $20, which is like, bro, basically an hour of someone's work. So go with the out the money while you're scaling these small accounts, but also manage the risk accordingly. You know, for me, I oftentimes tell individuals it's not a percentage thing, it's kind of a price action thing. And in front of me, I have an example of some of the trades I took today on a 0DTE SPY. I mean, it's kind of unfortunate, but the vast majority of my trades went my way. But I have an example here where, hey, I had to cut losses, and dude, it's a different component of trading that a lot of people have a hard time struggling with. And I guess you can say, aside from the capital exposure, the strike price, the expiration date, really just cutting losses is, oh my gosh, detrimental. Hardest thing to do as a trader, because none of us want to be wrong. All of us probably, for the most part, study price action. They're really convicted in their indicators or in their, I guess you can say strategy, which so many people on social media promote it as, that they don't want to be wrong when they're in a position. And there's different mentalities. Me working with so many clients, I've seen the fearful individuals that go negative 5-10% and get right out the position, and then the move happens. And I've seen the individuals that go negative 80%, 90%, and still hold the position. I've seen both psychologies. So you gotta know, a little bit of what type A or type B you are. Type A is very fearful, isn't afraid of being wrong as long as their money doesn't go anywhere. Type B is very aggressive, very, oh, you know what, man, like, I'm into this position, I don't care if I lose all this money, I better come out green something or I'm gonna lose it all. You might sound like, wow, that's a really interesting mindset. Like, who would think like that? But to my surprise, man, there's quite a few of them. So I want you guys to understand that, understand yourself personally. Are you a risk taker, or are you kind of more passive, or I guess kind of afraid of losing this, right? And this is going to be unique to everyone's situation, because if you're a risk taker, well, oftentimes you're going to have a little bit of a problem scaling your portfolio, because you're going to have very impulsive moments in your trading career where you may be going to a position with too many contracts, you go a little bit too far out the money, and you have a really rough day, and you can easily lose all your portfolio. But if you're very passive, type A, afraid of losing money, now you're kind of cutting stop losses. But the problem with a type A is that, hey, you're going in really light, that maybe your winners do good, you get 1 or 2 wins, but your third one can unset all of your losses. Or maybe you're cutting your positions too early and the move is happening after you get out because you couldn't tolerate that drawdown. So you have to be conscious of what personality type you are and also how your mind is thinking. So how I find the sweet spot in being a type A and type B kind of trader, right? You gotta have a little bit of risk. You gotta, you're in the boxing ring, you're gonna get hit, all right? But type A is like, hey, we work hard for our money, we can't just lose it like nothing. So to kind of manage both of those, I go without the money to keep my portfolio and capital risk manageable. I don't care if I lose 30 bucks. Of course, it's a lot of money, but it's something that we can tolerate. And to remind you guys, to lose that much money, you got to go negative 100%. By negative 40, 50%, there should be some alarms sounding in your head. Just to add a little bit of context for those of you guys that are brand new to trading, yeah, once a position goes negative 40, 50%, you're in hot water. And you might just want to cut it and just wait. Reset emotionally, take that break. Maybe don't take that break, step away from the charts, but hey, allow yourself to reset your emotions, your mentality. Watch your charts for 5 minutes, wait for key areas of supply to hit or demand to hit, and then re-enter. So, that's kind of that sweet spot. It's just finding out how much money are you okay with genuinely watching go to zero, okay? That's how you play type B, aggressive, but now with type A. Well, I don't want to lose my money, but Jerry, I don't want to sell a position before it goes profitable either. What do I do? So in front of me, I have a couple of trades that I went in with SPY today. I know my chart looks extremely hectic. I'm sorry, this is kind of how I digest the trends in the market to be able to make it understandable for me, and if you look closely at my entries, let's see, we had a win here at the beginning of market, we had a second win, and I think this was probably one of my first losses right over, okay, looks like this was a loss here. So if you pay close attention here, and I kind of did it to myself, I went ahead and of course, I'm sorry, I sometimes do break my rules, and I'm telling you guys comes with impulsive behavior. Not only that, I am neurally divergent. I have ADHD, so I'm kind of a little bit more impulsive than the vast majority of individuals. And around 767.50, I noticed previously in the trading day, there was a jump. There was strong levels of buyers present at this area. So I was like, you know what, hey, I'm gonna try the position out. So slightly before, it looks like I entered here at 767.66. I noticed first this extreme oversold scenario. We're taking big hits. You have all of this selling pressure from 10:11 a.m. to 11, even, dude, that's what? 11, okay, so that's probably like a whole hour. You have roughly 49 minutes of straight selling pressure. That has to end at some point, by the way. Once you guys get comfortable with price action and you really put in the time behind the charts, Like, bro, I know guys that have over 200 hours playing Call of Duty. Like, if you put in the same amount of time, or you just, some people have 200 hours doing any other hobby, you get familiar with price action. So you understand that when sellers take a really good amount of time and damage into the share price, buyers eventually step in. And there's a testimony to that, right? You got a really aggressive selling pressure for about 49 minutes, and then buyers step in and they undo almost, what you can say, roughly like 60% of it. So in front of us now, I typically like to enter where there's sustained points of buying previously, right? We can notice, well, Jerry, what's that sustained point of buying look like? That sustained point of buying could look like, sometimes when you're playing 0DTE, it could be a $0.50, so 0.50, could be a 0.75, could be a 0.25, or a whole number. So in this situation, I notice, okay, 67.5 has held, and there's buyers that loaded up previously in the day at 8:30 a.m., potentially around this point, now at 11 a.m., we could see the same thing. But I jumped the gun too early. And of course, like, if I would have held, I would have been fine, but let me tell you guys the negative side. The negative side would have been, I held it with the large amounts of capital, hypothetically, right? Let's say I'm in this $1,000. Well, $1,000 from a drawdown from 0.65 to 0.50. If you're familiar with trading 0DTs, you know that much down, that's roughly 40% down the drain. Easily. Maybe 30, let's be humble. Dude, that's minus $300 in what? 1, 2, 3, 4, 5, 6, 7, 8, 9 minutes. If I say 40, dude, that's $400 in 9 minutes. Not a lot of people are used to doing that, right? And that's why I tell you guys, like, this is a very difficult career. It's a very difficult form of income, but it's one that you have to adapt to. And this is why I tell you guys, play with light capital. Because now, if we change that scenario, right? If we're only in a position, $30, right? 0DT out the money contract, and I'm negative 40%. Well, we know now that 20%, right? $30. Well, let's say 10% of that is $3. 20% is gonna be 6 times the 20% times 2. You have $12 down the drain. Now you compare that to thousands of dollars. There's $400 gone in 9 minutes, but then there's $12 gone in 9 minutes. Which one do you want? Probably the $12, right? That's why I tell you guys, find that sweet spot, pace yourself. And I say this because not everyone is in a difficult financial situation. I worked with clients that have money. They're making well over $20,000, $30,000 a month. Some are from very wealthy families. Some people have really interesting forms of income where they make $7,000, $8,000 in a day. And I know this sounds outrageous, but it's true. So I give this as a fair warning for both sides, both the very ultra wealthy and the very, up and coming individual, getting it on their own. Find your sweet spot. And I don't mean this that, even if you're a high income individual, like, I recommend you take it slow. I recommend you bring yourself to a very humble level in your life. Hey, you're learning something new. There's no reason you got to be prioritizing the money. Prioritize learning how to manage risk, prioritizing how to pick the right contract, right? You can learn the $12 lesson, or you can learn the $400 lesson. Which one do you want to learn? Probably the $12 one, right? Save the money. So that's a little bit of a component back into that point A sweet spot, but also that point B. Now, entering kind of a stop loss. Well, what can that look like, Jerry? Like, I want to protect my positions when I'm in. Well, ideally, me now giving you this heads up, entering around $0.50 or whole numbers. Typically, I work points in 0DTE contracts. Price action typically likes to put up some fights. So in this scenario, I entered at 0.66, kind of missed the entry, got a little bit impulsive, trying to catch, this bottom on this, aggressive selling pressure from 10-13. I'm like, you know what? This is the bottom. We're accumulating. I'm in. Overpaid, but I know this shows a really big stop loss here, but at the end of the day, I only ended up losing roughly probably 15%. So if I entered on a $13 or $30 contract right there and I lost 15%, I lost probably $6, $7. And what does this look like, Jerry? Well, I entered at 0.66, and once I seen us break below 0.50, I stepped out for a total loss at probably this was a little bit more of a drawdown. I took a stop loss like at 0.44. So it's not percentages. It's not really like, you can say like money-wise where you want to take the stop loss. It's at share price. Okay, are we losing? Are we gonna go down a 767 flat? And am I really gonna hold an entry from 767.60? No, we're down 60% of a dollar. Why would I hold that, right? And sometimes it's not even just holding all the way down to a whole number. Like if you see that selling pressure still aggressive and present, this comes with understanding price action, watching it every single day. You build a little bit of a, I don't know, your mind picks up on it. Your mind finds the patterns. It understands it slightly differently than someone that's never seen it before. So with that being said, you know, now that we got that selling pressure, well, what does it look like when I take the stop loss? Well, we know we're approaching a level of buyers. So doesn't mean, oh, I got to egoistically hold this until my play works. No, I could take that minus, you know, 13, 15%, and then look, reposition at 767.49, which I actually did, and I went ahead and entered. I took the stop loss, right? I took the stop loss for minus $40. Pay attention to this. I took the stop loss at minus $40 at 11:09 a.m., right? 11:09, let's put a little box on that. 11:09, right at this bottom. Literally, I sold for a loss, but look, I noticed we're at 767.42. So at 767.42, I noticed, hey, we're near that $0.50. Maybe I got a little bit frightened, which is type A, you know, scared to lose money. Of course, it happens, but also don't just give up. You know what I mean? Pay attention and be conscious of it. So I noticed that I did step out at a point where, hey, yo, buyers actually are stepping in. I wasn't wrong. I just mistimed it. At 11:10. At 11:10 a.m., you see that? 11:10. So I went ahead and bought right back in. I sold at 11:09, but at 11:10, I noticed what? Well, let's pay attention to one thing here. What is that share price right at 11:10? 767.50. I'm playing the $0.50. I'm playing that point that, hey, previously, buyers were at. Yeah, I sold it because, that selling pressure was very aggressive for the last 49 minutes. Do I want to contest that? I mean, I tried to, but I lost. But I picked up quick on that 50 holding up. And then later on, once we went ahead and sold the position, right, I entered at 11:10 and I sold at 11:14. All right, and just 4 minutes later, I made a total profit of $160. Mind, I lost $40 the trade before, so I'm technically plus 140 now. And 11:14 was literally right here, right at this top. And why did I sell right here? Well, I sold right here because prior to this level, we were having early market rejections around 8:30 at the same 768. So notice, I took it from a 0.6750, only the $0.50 to 0.768. Could I have held for more? Absolutely. But am I willing to risk it for the full Hail Mary? No. My point B when I was younger, or type A, B trader when I was younger, probably would have. But being a type A a little bit more conservatively now at basically going to be 24 years old in 10 days, which is wild. I'm okay with, taking what I can and playing it safe at that 768. Because I know that around 768, hey, after 49 minutes of selling pressure, we get, 9 minutes of green? Dude, you think that's over? No, sellers are still there. They're hawking down. When is it they're going to step in and buyers are, going to face that wrap? So ideally, you have to learn how to play share price as your stop loss, as your entry, rather than too much of trading patterns or really supplies and support, resistance and demand. Supply, support, resistance and demand, they're great. But you have to learn price action around share price, understanding buyer and selling behavior. And every day is unique. You have to adapt to that. One thing I can tell you guys is you're not going to cheat the game. You have to put sometimes hours behind a chart. I know a lot of us are very busy with life. And that's why I tell some people investing is probably going to be your best approach. But if you do really want to learn how to trade options, you're going to have to put some time into getting familiar with these concepts. And that's why I make these videos, to hopefully speed up the education process, the years of knowledge that, dude, I had to accumulate to be able to transfer them to you a lot sooner. So at 768, learn these positions in share price where, buyers and sellers begin to act a certain way, and you want to respect the markets and find your entries and exits. And like I mentioned, it's okay to be wrong. Like, I entered here. Am I defeated because my position ended up playing out later? No. Took the stop loss, reposition, and then I came out on top. And this is why I share with you guys risk management, because like you have to also understand that, dude, in this whole entire journey, there's gonna be moments where you are going to finally make progress. You're gonna make a lot of capital. You're gonna start, oh wow, I turned $100 into $500. Yeah, it's amazing, dude. That's what I did this morning. I turned $156 into $400. It felt phenomenal, but imagine I would have went all in at the end of the day on some risky, impulsive decision, and there goes everything. So managing your emotions, managing, I guess you can say, understanding realistically what you can afford to lose, and not even just what you could afford to lose, because when you're in that trading mindset, you're not afraid to risk it sometimes, especially if you have momentum in the day. So really learn how to control, I guess you can say, that impulsiveness and manage these decision making, as you progress through your career. And I tell you guys this because I've seen a lot of individuals, come into this wanting to make a lot of money. Sometimes they go into this with a lot of money and they do make a lot of money, but then they end up giving it all back. So you're not in a rush, reminder from it's a marathon, not a race. The market's gonna open up the next day. It doesn't care if you show up or not. It's gonna happen. 20 trading days out the month, it's gonna happen. Are you gonna be there or are you gonna miss out on it? A great mantra that I say is green over greed. Dude, there's been positions that I walk out with 15% profit just because that price action, the buyer side or the sell side did not look too strong. I'm okay with folding cards, coming out green, and the second I step out for 15%, boom. So it's a blend of monitoring price action, understanding the behavior of sellers and buyers, who's stronger, who's weaker, and around which key levels or share price levels are they going to get stronger or get weaker. And that's how you time your entries. That's how you manage risk. This is pretty advanced. I don't know exactly how your guys' minds are going to comprehend this information. If it's going to make sense, it might sound like Spanish or, some whole different language, but I hope that it helps you guys to the best of my intended ability and you guys understand a little bit more. Key takeaways from this video are watch where share prices are being held by buyers or sellers. Those are where you want to begin to time your entries aside from supply demand lines. And also understand the half dollars, the 0.75s, the 0.25s as potential take profits or potential stop losses. When you see these levels begin to get swept away, there's an opportunity there that potentially they can go lower, or go higher. So, be mindful of those. And honestly, the second one, the final component would just be being okay with being wrong. It's not every time you're going to get into a trade and you're going to be 100% right. If you notice these, strengths in sellers or buyers being slightly different, it's okay to fold your cards, reposition, and like you've seen I did, come out on top. So I hope you guys enjoyed this video. It's kind of long, but it's loaded with a lot of information. And I know it's a very subjective perspective into the market, right? It's unique to myself, but I hope that someone out there with that building experience or has the experience can align with it and see what I see to be able to generate the same exact results and come out profitable, and more importantly, provide for yourself and provide for your family and those that you love, and really just never give up. So I hope you guys enjoyed this video. Thank you all for watching. Jerry Trades the SoCal Trading Group, over and out.